interest rate is changing from 3.25 to 4.5, my monthly payment is
Mm,
going up $172 a month. So that's why it's really important to, just to make sure that if you're not wanting your principal and interest payment to change, to stick with a fixed rate mortgage. Again, adjustable rate mortgages, they're not bad, but you have to really commit to understanding that your rate is going to change within a certain period of time, and it's going to change until you refinance or until you sell that house. So that's definitely what was happening, is that families were getting into these adjustable rate mortgages, thinking, oh, well, look at my monthly payment, it's really low, and not understanding, because back
mm.
then the type of disclosures that we were giving, were not it. Some of them were not very clear. It was very easy for someone to misunderstand. Oh, my rate's going to change in 2 years.
Yeah, and then even more so if there was a language barrier, right? People are like, "Oh,
Absolutely,
yo no sé qué, deje firmar," and then they may
exactly.
not understand. So, what where's the strategy of what did you just call it? It's not a fixed rate, it's a
An
emer
adjustable rate mortgage.
an adjustable rate
Uh-huh.
mortgage. So, what's the strategy for that? When would you want to have an adjustable rate mortgage?
Yeah, it is for clients that are really going to live in the house, maybe for a very short term. They know that
Okay.
maybe if they have an employment contract, and their contract is up in 2 years, and they know for sure they're going to move. That's kind of a good example. If we project rates are going to drop, or they're comfortable with their mortgage payment changing, because typically on an adjustable rate mortgage, on an ARM loan, the initial interest rate is a little bit lower. So it's a very
Oh,
attractive. That's why.
I
Mhm.
see, I see. So it's lower than a fixed rate.
Mhm.
So then you basically take the risk that it's not gonna
Yes,
go up
absolutely.
because why would it go up if the economy? Because and again, I'm asking because I don't know.
Sure.
So when people, so those who let's talk about those who did know back in 2007 or eight, those who were aware of ARM or adjustable rate mortgage, of how it worked, and those who decided to go ahead and get an adjustable rate,
Mhm.
they assume the rates were going to not go up. But I guess I don't understand how the economy going down made the rates go up back in 2008.
Yeah, there was a lot of factors that went into the and that goes into rates, kind of
Okay.
changing. One of the biggest things that was happening is that, these adjustable rate mortgages were very easy to get back then. So we
Oh,
used to have, oh yeah, we used to have loans called Nina, no income, no assets. What that means is that
wow.
we would just pull a credit report, and we would take your word for it that this is your income. You would tell us your income. You would tell us what you had in the bank. And back then in 2005, we didn't have to prove that's what you had in the bank. We didn't have to
Mm,
prove that's how much you were earning. So that's where the trouble came in, is that you could inflate. You were on the honors system,
yeah,
that
yeah,
you were
yeah, yeah.
giving the correct information, but if we're not having to prove, then that leaves the opportunity for fraud.
I got you. So part of it is, or back then it was a lower barrier to entry to get a home, to go through the
Definitely.
adjustable rates more.
Definitely. If you had a pulse, if you were
Got it.
living and you maybe had a job, you could buy a house back then.
Wow. So yeah, as you mentioned, you've been in the industry for 15 years. Have you been
Yeah.
with a guaranteed rate that long, or is this your company? How does it work when you're in the real estate? Yeah. Oh,
Yeah, Guaranteed Rate is a mortgage company. I
okay.
actually just joined Guaranteed Rate back in November of last year, for lots of reasons. Guaranteed Rate is very high tech. They have lots of programs, that I wanted for my first time home buyers, that I wanted to be able to offer, and they had really competitive interest rates, and just folks that were very committed to helping people become homeowners. So I've worked for different companies. I've worked for banks before. I've worked for a different mortgage company for a couple of years. So I just joined Guaranteed Rate in November, and I'm here to stay. I planted my roots.
Oh, got it, got it. And then as you say, you're a broker. Is that correct?
I'm a loan
A loan
officer.
officer.
So
Yes, because
yeah,
I don't understand the different roles. So okay, so
sure.
there's different players, right? So
Yeah,
there's a loan officer, but there's a broker, but there's a real estate agent. Can you explain how that works?
absolutely. So the word broker, the definition of broker basically means middleman. So
Okay.
a mortgage broker is more of like their own business owner, and they have mortgage brokers have access to different investors, different companies that they can go to get the same type of loan. And the reason why
Um,
they like having access to different companies is because every company's guidelines, their rules to give out loans is just a little bit different from company to company. Or maybe their interest rates. Some investors are more competitive than the others. So we're considered like a mortgage bank. So guaranteed rate, we fund our own loans, and then behind the scenes, the what our customers don't see, not really important for them to see it, is that behind the scenes the loans are sold to investors in the secondary market.
ah, got it. And that's the cash keeps flowing that way.
Yeah, so I work directly for the mortgage company, whereas a
Got it.
mortgage broker can kind of pick from different mortgage companies or different investors.
Got it. Over the course of your career or the time in the industry, what obviously in '05 you joined right when it was like hot, right? What was one of the reasons that you joined? Was it a change in profession? Was something you wanted to try, or how did you get into the industry?
You know, most people that are in mortgage and real estate do not grow up thinking they're going to be or dreaming. I always dreamt I would be a doctor, not a mortgage loan officer. I kind of fell into it in 2005. Actually, I was still in college. I was a senior, and my someone that I had worked for, my previous manager I had worked for at a bank, moved into the mortgage division and said, "Hey, I'm doing great. I really need an assistant." And I told her, I said, you know what? That's great. I love you. I can only work 20 hours because I'm still in school.
Yeah.
And so I went to go work for her, thinking I would be there for a year until I graduated, college. And then I ended up staying. I realized that very quickly that I was helping families build generational wealth. And, we all have a personal story, and I have my own story of why I'm so passionate about home ownership. Is, when you're a homeowner, you have the opportunity to go through life in the same four walls that are providing security. They're providing, home ownership creates community, it creates stability for kids, and for your family unit. So that's why I'm so passionate about home ownership. But yeah, I didn't grow up thinking I was going to be a loan officer. I just kind of stumbled upon it, and it captured my heart, and I have not left.
Yeah, no, that's a really good point because it's very it can be very psychological, right? Like what like the fact that you own a home, that your family has a place that's theirs, that they're not worried about, not going back to their apartment or anything. Yeah, so
Exactly.
cool, that makes sense. So you entered the market '05. It's like
Uh-huh.
hot. It was like red hot. Tell us
Yeah.
about that experience when you entered, and then after going up, and then maybe down right after that.
Oh, that financially, mortgage and real estate, it's a very self-rewarding career, but it's a very financially rewarding career as well. And, back then, being able to help a lot of, families meant you were making a really good paycheck. You were able to save, and you were able to, have fun and take vacations, and life was crazy back then. I kind of entered the market right at the tail end of all of this. It really kind of peaked in about 2004, 2005, and
Okay.
I was just getting started. And then the crash was soon after in 2007. So, yeah, you would hear folks saying, "Oh, I've bought 10 properties, and I bought a yacht, and I took my family to Europe for a month." And you're like, "Wow." I never really
Wow.
experienced that. Instead, I actually invested the bigger paychecks into renovating the house that I had purchased.
Oh,
So,
nice.
surprisingly, I was making a great decision, great choices in my 20s.
Yeah, yeah, yeah.
Yeah,
Not
and during once, you know, any back then, when you would kind of see what was going on with loan approvals, and you're like, wow, how did they become a homeowner if they have no money in the
Mm,
bank, or maybe they have really bad credit, like they just have lots of collections and lots of late payments, and the writing was on the wall. It was really obvious, at least to me, that that wasn't the normal way of doing business. And again, we're not talking about buying cars. We're talking about buying houses that are, you're borrowing 100,000, 200, $300,000. That's a lot of money to pay back.
yeah,
So when the crash happened in 2007, I was not surprised, not one bit.
yeah, yeah, definitely.
Yeah, but what ended up happening in 2007 though is because of all the foreclosures, the home prices ended up dropping. And because they dropped, my families that were maybe like in that were lower brackets that couldn't afford to buy a house, at least in Houston, you could buy an 1,800 square foot house for $100,000, $90,000. So my families that were in the lower income bracket were able to finally afford buying a house. So it brought me much joy. Those were actually some of my most
Yeah,
successful years, was being able to help my, working American to become a homeowner.
yeah. Definitely. And I think that's what maybe people are thinking is going to happen now. The reason I say that because I live in San Jose, right? I live in the Bay Area, and right here it's outrageous. And talking to some friends, we're talking about, like, it doesn't make any sense. Like say like a computer engineer making like $200,000-300,000 is having a hard time buying a home because they're 700,000-800,000, close to a million. And then even if they save up enough money to even get in, somebody else comes with just cash and just takes away the property. And I mean, and I know it's a unique situation here, but in other cities, it seems that it's going up as well. Do you think we're getting close to another bubble because of that? Because and going back to just common sense, like looking at the picture, be like, man, either people have to leave away from the Bay Area or even California, or they have to go out, into like Fresno. Even that's getting expensive, right? Or just go to another state. But I don't know if it makes sense either. I feel like something's gonna pop or something. But what's your take on all this?
Yeah, having been through the recession the first time, and housing is what caused that. Um, what's causing our circumstances right now, gratefully it's not housing. Gratefully it's something else. And sadly it is a pandemic that is causing all of this ruckus in the market, and just all that's going on. So it's hard to compare, but what happened in 2007, and the years immediately after, is that folks could no longer afford to buy a house.
Okay.
And it's not necessarily because they were losing their jobs. So there wasn't a pandemic last time. They weren't losing their jobs. It's just these going back to the adjustable rate, their interest rates were starting to adjust. And all of a sudden
Mm,
their interest rates are going up and their housing payments are going up. And if I fibbed on an application and I said I make X amount of money, and my income was actually a lot lower, and just because just because I had a great credit score and it helped me get into a house. Well, if my payment is going up and it's going up every single year or every 6 months, there's actually 6 month adjustable rate mortgages, um, then that impacts me being able to pay my mortgage. So it's this cycle where if I can't pay my mortgage, then you end up foreclosing. And once the foreclosure started happening, that's when the rate, the in the market started dropping. So I'm really curious to see, and not to, dance around your question, but I'm really curious to see what's going to happen. It's not necessarily the housing market that's creating this, it's the pandemic and it's the job
yeah.
loss. But we're better positioned this time around as a country and as a government and as, smarter and better financial institutions to try to really, for lack of better term for lack of better words, to not let it happen again what happened, 10 and 12 and 15 years ago. So
Mhm.
we'll see. I wish I had a crystal ball
Yeah.
to, kind of say what's going to happen, but we'll see.
Yeah, no, thank you for that feedback. Yeah, and then that's why we have different like guests and different experts here
Uh-huh.
just to get that feedback. Awesome. I know you had some other data you were gonna show, right? Some other graphs here.
Yeah, absolutely. To as you're looking at if you're looking at getting into a home, whether you're moving up, you're downsizing, if you're buying an investment property, if you're buying your first home, right now I have clients all across the board. I have my first time home buyers, and then I have mine that are moving up or downsizing or investing. Your pre approval is going to be your secret weapon. Right now, we really can't be out and about. We really shouldn't be out and about. So, for someone to place their house on the market, they're going to want to work with only serious buyers. So make sure that you get pre-approved. That's where a lender has checked your credit. We've looked at your documents, like your tax returns and pay stubs and bank statements, and we can actually give a pre-approval based on the documentation that we have seen, not what you've told us, because what you tell us and what we see could be two different things. And
Yeah.
then also, this is a really great this is a really great image that shares, if you're renting, let's say you're paying 2000 a month in Houston is pretty average. What's your average rent in California, at least where you're living?
Yeah, for like my one bedroom apartment, it's like $2,400.
Yep.
So I think because I'm in the Bay Area, but the
Yeah.
average rate though, yeah, it may be a little less than that. Yeah.
Okay, okay. So sticking to the 2000, a month in rent, after 3 years, you have paid 72,000 towards someone else's mortgage. If
Wow.
you look at 10 years, you've paid 240,000. So renting really adds up.
Yeah.
Homeownership is not for everyone. I understand it. I get it. But if you can become a homeowner and if you can invest in paying yourself back, do it.
Yeah, I mean, and I'm putting myself in this
Mhm.
situation right now because 3 years goes by quick. I mean, I've been renting for more than that, and I already probably spent like 100 grand, and
Yeah.
without even thinking about it, right? When I could have
Yep.
invested. Yeah, so awesome. This is an eye opener for sure.
It's always an eye opener. It definitely is. I when life was changing, I bought my first home and then I moved out and took the equity from that property, and I waited a couple of years to buy my next home because I didn't know where in Houston I wanted to buy.
Mhm.
And 1 year turned into 2 years, and after that 2 years I was like, no, I've got to start paying myself back again. So I bought my next home. But yeah, that graphic right there is pretty eye opening.
Yeah, no, definitely. No, that's good. And then so with that said though, I know a lot of people are like, I know I want to buy a home, but I don't know if I want to live in this town for the next 30 years of my life. What do you say to people that are thinking that they may relocate, or when is the right time to buy a home? Is it when you have a family and you have roots? Is it when you got a full-time job and you shouldn't leave that town? Is location a, a big part of that? Choosing
It's
a-
at the end of the day, it's about, do you have stable income and do you have, a little bit of money to get into your house? The average first time home buyer lives in their property on average about 5, maybe 7 years.
Ah,
So, and then after that, it's rare nowadays that you see someone kind of living in the house years, until you've kind of really figured out, like, this is where I want to live. This is where I'm going to plant my roots and stay forever. But yeah, the average first time home buyer stays in their house about 5 to 7 years. So it's very normal to look at selling a property within that time, within that first 10-year time period.
yes, yes. See, that's a good point. So it's not like you're gonna be stuck there for 30 years in this town or
Yeah.
city.
And and you don't have to just depend on your loan officer to talk to. That's where a real estate agent, a realtor, comes into play. Just like it takes a village to raise a child, it takes a village to get a homeowner into a home, or a potential homeowner into a home. So in the process, you actually have a realtor, a real estate agent who's licensed. Where I have to be licensed. I take continuing education classes just like you do, Tony, and
Mm-hmm.
um, and a real estate agent is going to be more in tune with the local market. So a realtor is really the one to talk to understand the trends, understand what's going on with maybe if it is it a good school district? Is it going to be attractive if I want to
Mm.
sell? So talk to your realtor. Your realtor is going to be one of your best go-to folks because like I'm licensed in Texas. I can lend anywhere in Texas. So I don't necessarily know the communities in El Paso. I don't necessarily know the communities in San Antonio, in Dallas. I can lend there, but a realtor is going to be really in tune with the local market.
Yeah, yeah, definitely, definitely. Awesome. Well, thank you for all the information you've been sharing today. I know, like a lot of the viewers, they're commenting, yeah, gracias por la información. Thanks. Let us know when you're gonna be back on.
I
And
love it.
so, yeah, maybe we can make this like every other month or something because we
I
definitely
love
want
it.
to keep bringing different experts on. But any last words before we sign off?
Yeah, thank you so much. Home ownership, it's a wonderful, wonderful thing. Home ownership creates community, it creates stability, it generates wealth. It gives you, if you have children or you're thinking about having children, it gives you the opportunity to build that wealth to then pass on to your children. I know that I want my son to have an even better life than I have, and I get to. He's already told me he's 8, and he already said, "Mom, this is going to be my house. You get to move out, and I get to keep the house." He already wants to live here, so I'm like, you know what? That's realistic. I can give him this home as a gift when I buy my next home. So, homeownership is a good thing. Don't be discouraged. Rip the band aid off, talk to a loan officer,
Hmm.
see where you stand financially, and get a plan. Put a plan in place. It may not be, homeownership may be closer than you think, but you won't know unless you talk to someone.
I love it. I love it. Awesome. So Veronica Martinez with Guaranteed Rate. Thank
Yes,
you so
sir.
much.
Likewise, thank you. And I'll leave my contact information up here if anyone has any follow up questions.
Oh, yes. What I'll do, everyone, I'll add it to the comments so people could
Awesome.
then, when they see these videos later, they're able to find you and give you a call.
Very cool. Thank you so much. I appreciate you.
So talk to you soon. Bye.